Hi, welcome to Knowledge Shop March 2025 Tax Roundup, your monthly dose of tax insight to stay informed and stay ahead. This month, we are circling back to the Bendel case and looking at further developments and what it means for you and your clients. We're also taking you through the government's exposure draft legislation on Payday Super to unpack the key proposed changes. But first, the Australian federal budget for 2025 to 2026 was released on March 25th. For a comprehensive summary, you can download the Advisor Edit from Knowledge Shop's website. Now, following the budget announcement, two bills were introduced to Parliament with their outcomes contingent upon the federal election scheduled for May 3rd. Now, the first bill is the Tax Incentive Integrity Bill. Now, the bill includes a number of tax-related amendments and it's now passed both Houses of Parliament and awaits royal assent. Broadly, the bill includes amendments for tightening the definition of a fuel-efficient vehicle for luxury car tax purposes, but most importantly, extending the 20,000 instant asset write-offs for small business entities to 30th June 2025. So while the increased threshold for the instant asset write-off to 20,000 has finally been passed for income year ending 30th June 2025, there was no mention of any further extensions of the increased instant asset write-off threshold past that date in the 26 federal budget. If there's no further amendments to the rules, then the instant asset write-off threshold returned to 1,000 after 30th June 2025. Another bill that has been introduced and passed by both Houses of Parliament, which covers the individual income tax cuts and changes to the Medicare levy thresholds, it was announced in the federal budget. So the bill also now awaits royal assent. So Schedule 1 of the bill proposes to reduce existing personal income tax cuts from 16% for that $45,000 bracket to 15% for 2026 to 2027 income year and to 14% for the 2027 to 2028 income year onwards. A Schedule 2 of the bill proposes to increase a certain Medicare thresholds, Medicare levy low income threshold for individuals and families, Medicare levy lower income thresholds for individuals and families eligible for the Senior Australian and Pensioner tax offset, and surcharge low income threshold in line with the CPI retrospectively from the 2024 to 2025 income year. Now, the progression and implementation of these bills will really depend on the composition of the Parliament following the upcoming election. Okay. Next, let's look at the Bendel case. Mike, it looks like there have been some further developments in the Bendel case dealing with Division 7(8) and unpaid distributions. Can you fill us in on the details?
Yeah, the Bendel case continues to be the big news item really in the tax world over the last little while. And you might recall last month we referred to the full federal court decision in the Bendel case, a really significant decision which kind of really casts a significant question mark over the ATO's approach to unpaid present entitlements owed to corporate beneficiaries. Long-standing ATO approach that's kind of been around for 15 years plus now. And really the question that we had last month was, well, what next? What's actually going to occur? Is this it, or is there going to be another round? Well, it looks like there will be another round. This month, the ATO has basically lodged an appeal with the High Court. Now, it doesn't go straight to a High Court appeal. What happens is there's basically an application to seek leave to appeal. So there's kind of a two-step process. It might be that the High Court actually says, no, we're not going to actually hear this case, in which case that will be the end of the matter. It is also possible that the High Court might decide to hear the case, in which case we won't have a resolution on this for some time. It might take a significant period of time for this to kind of work its way through the High Court process until we have what will then be a final decision from the High Court. So for the time being, we're really waiting to see whether the High Court will hear that appeal or not. And then obviously we'll let you know what the outcome is once we know about it. Now, in the meantime, the ATO has released a decision impact statement. I think it's an interim statement at this stage. The ATO released an earlier decision impact statement when it lost the original AAT case. This builds on that following the loss at full federal court level. Basically, what the ATO is telling us is that until the matter runs its course with the High Court, whatever that looks like, the ATO is going to continue to administer Division 7A consistent with its existing guidance and guidelines. That is, that unpaid present entitlements owed from a trust to a corporate beneficiary could be treated as if they were loans for Division 7A purposes. So the ATO says, even though the full federal court has said that they are not loans, the ATO will still treat them as if they are until the High Court has its final say on the matter. Now, I think for some people that will be a fairly frustrating approach that's been taken by the ATO. It is what it is. And obviously we'll just wait and see how long it takes for the High Court bit to play itself out. Having said all of that, what the ATO has said is that until the outcome is known in terms of that High Court appeal, it basically will stop processing private rulings, amendments and objections, those sorts of things, reviews, which relate to this specific issue. So the ATO will kind of put a pause on processing those things until the High Court appeal outcome is known. However, there is a but. If the time limit for the amendment request, whatever it might be, is running out, or if the taxpayer basically forces the ATO to make a decision, the ATO says it will make that decision based on existing guidelines, effectively ignoring the full federal court's decision. So that's where things stand. It doesn't necessarily give us a great deal of information in terms of what do we do in the short term. For example, what about when we kind of are getting close to having to really prepare and lodge a whole bunch of 24 tax returns? What do we do with those? The answer is not clear at this stage because this still is in limbo to some extent. So there's still a little bit to play out here. The update is the ATO has decided to appeal the decision. There is an interim decision impact statement that's been released, but beyond that, there's still some question marks.
So, Mike, has the ATO provided any indication of how it would deal with unpaid distributions owed to corporate beneficiaries if it fails in the High Court appeal?
Yeah, look, I mentioned earlier about the decision impact statement that has been released by the ATO in connection with the full federal court decision of the Bendel case. There is another bit of information in that decision impact statement, which it's not unexpected, actually. Basically, what the ATO is saying is that even if it turns out that they were wrong all along when it comes to Division 7A and unpaid present entitlements, that doesn't mean that there aren't other tax issues when it comes to those outstanding unpaid entitlements. And again, not surprisingly, the ATO has suggested that they could potentially fall within the scope of Section 100A, the reimbursement agreement rules. A lot of us have heard a lot about Section 100A over the last few years because the ATO released a ruling and a PCG around 100A. And a lot of us have had to kind of spend a lot of time getting our head around the ATO's approach in that space over the last few years. Now, basically what the ATO is saying is that if it turns out that they are wrong on Division 7A and unpaid entitlements, then we would then look at Section 100A. Section 100A, in essence, is basically saying that where income is appointed from a trust to a beneficiary, and the real benefit of those funds is enjoyed or provided or applied for someone else's benefit in connection with a reimbursement agreement that is not part of an ordinary family or commercial dealing, that can trigger a tax outcome. And that tax outcome basically is that the trustee of the trust, which appointed the income to the beneficiary, is taxed on that amount at penalty rates. So that's our 100A treatment if indeed it applies. Now, the ATO isn't saying that 100A will definitely apply when there's an unpaid entitlement owed to a corporate beneficiary. But if you think back to some of the ATO guidelines that were issued a couple of years ago in terms of 100A, there were some green zone scenarios. The ATO basically saying, if the arrangement is structured in this way, then we wouldn't seek to apply 100A. The risk of that would be low, and you would have some comfort, I guess, that the ATO won't kind of devote compliance resources to applying 100A to those specific scenarios. One of those specific scenarios deals with entitlements owed to a corporate beneficiary. And the ATO says if certain conditions are satisfied, then they would treat that as a low-risk arrangement, probably not going to waste their resources looking at that in any great detail. Now, in order for that arrangement to fall within the green zone when we have a corporate beneficiary, there's some conditions that need to be satisfied. One of those conditions is that the arrangement is basically on terms that are no less commercial than a Division 7A loan agreement. And so effectively what the ATO is saying in this decision impact statement is that, look, even if it turns out there is no Division 7A issue in terms of that unpaid entitlement being treated as if it was a loan, if you don't have a Division 7A loan agreement in place for that entitlement, that amount that's owed, then you probably are going to fall outside the scope of that particular green zone scenario, raising the risk of Section 100A being applied. Now, again, that doesn't mean that 100A will automatically apply. It's a little bit more complex than that. But what the ATO is suggesting is that if you fail to have that thing under a complying Division 7A loan agreement or similar terms, then effectively you would have a higher level of risk. You would have a lower level of comfort in terms of the ATO wanting to look at that arrangement in more detail through the lens of Section 100A, if that makes sense. So I think even if the ATO loses the High Court appeal, I think what we'll see is probably a fresh focus on 100A. There are other aspects of Division 7A that still come into play that might be relevant. Subdivision EA is a prime example of that. So Division 7A is still a live issue, even if the UPE is not a loan in its own right. The other thing, of course, that we're still waiting to see is, will the government step in? Will the government step in and change legislation to basically kind of make the rules work in the way that the ATO thinks they've been working all this time? That's the other big unknown at the moment, and we really don't have clarity on that just for the moment. So there's still a lot to think about in this space. We still don't have any easy answers. It would be really nice to say black and white, this is what you do, this is when you'll have a problem, this is when you won't have a problem. I don't think we're at that point just yet, and that will probably make a number of people feel a bit uncomfortable. It is what it is. We just have to kind of live with that uncertainty for the time being and deal with it in a practical way, while acknowledging certain things are going to probably have higher risk than others. But we will, of course, let you know when there are any significant developments in this space. A lot of people kind of wanting to have a really clear answer on this. We don't have it yet. We will have it at some point, and we'll let you know once we do.
The government has released the exposure draft legislation on Payday Super. What are the main changes that are proposed?
March saw Treasury release some draft legislation for the proposed Payday Superannuation measures. These measures were originally proposed in the 2023 federal budget, and as the name suggests, the plan is to move to a system where super guarantee is paid in line with an employee's payday. So currently employers have until the end of the quarter or 28 days after the end of the quarter to make those SG payments. It is proposed from 1 July 2026 that they will need to make those payments 7 days from the employee's pay period. So whether that be weekly, monthly or fortnightly. There are some proposed allowances for new employees or ad hoc out of cycle wages. So an extra couple of weeks for those events. Also, the legislation is proposing that the ATO clearinghouse will close as well. So the big message for employer clients is they're really going to have to get better at this. So we are seeing some employers even struggle with the quarterly requirements. So cash flow wise, employers are going to need to come up with the money on a more regular basis. Clearinghouses, we feel, are another area that need to be addressed as well. We are hearing that some commercial clearinghouses aren't even processing the payments within 7 days. So that's certainly something that we're hoping that Treasury will take a look at. On the positive side, so currently, as soon as super guarantee is late, it becomes SGC, and that payment plus any penalties are non-deductible for the employer. So even a 2-day late payment, an employer will lose the deductibility. So under the new proposed system, so although employers need to come up with the money a bit more regularly, if they do make a small mistake and perhaps they're a couple of days late, then they won't lose the deduction on that late payment. So they'll still be able to claim a deduction. The interest will change. So currently there's a 10% interest on that late payment, which goes to the employee. That will change to GIC. There's also an administration component. So currently that administration component is $20 a month. That will actually be changed to an administrative percentage, so up to a 60% uplift. So that sounds quite high, and it certainly can be for employers who are repeat offenders or employers who don't self-disclose. So while 60% is the starting point, there's also the ability to self-report. And if someone has a clean record and they self-report within 28 days, that administrative penalty will be brought down to zero. So they'll just have to make the late payment to their employee's account and also pay a little bit of interest on that as well. So a lot to get used to for employers as far as cash flow, but we think there's some positive signs when it comes to fairness and deductibility, and also not punishing people that generally do the right thing and make a small mistake, not punishing those employers too much, but then punishing the employers that consistently do the right thing, which should really be the aim of an SG system. So we'll keep you up to date. There's still a consultation period, and then we have a bit over 12 months. We also have an election looming, but this does seem to be something that Treasury is working on in the background. So we'll watch this space, but certainly something to start discussing with your employers to be mindful that they'll need to have more regular cash flow to pay the super guarantee, and also employers that use the ATO clearinghouse as well, they'll have to start to consider other options, so perhaps a commercial clearinghouse.
Now, that's a wrap for this month's Tax Roundup. As always, our goal is to keep professional advisors ahead of the curve, helping you navigate tax complexities with clarity and confidence. At Knowledge Shop, we make the lives of accountants and advisors simpler and more efficient. Our membership services gives you access to up-to-date knowledge, a comprehensive suite of training programs, work papers, and our hugely popular help desk service, which is your go-to resource for practical, reliable support when you need it the most. If you're not already a member, now it's a perfect time to get in touch and see how we can support you and your clients. Thank you for watching, and see you at the next Roundup.